Hello, my name is Brian Overby. I am the host of Options Guide TV, the author of the Options Playbook, but today is not about me. We have Kirk Plessis with us from Option Alpha, and we're going to talk about bot trading. It's been approximately 9 years since I've had a public conversation with Kirk, and I'm excited to ask him a lot of questions. For about the next 30 minutes here, we're going to be chatting about options, and I think you're going to want to hang around and listen to the conversation. Well, hello, Kurt.
What's going on, man? How are you?
I'm doing great, and I have to tell you the true reason why I wanted to invite you on Options Guide TV is that you recently we had a great event through Tradier and the Chicago Board Option Exchange. They did an options summit, and I really enjoyed your presentation, but you didn't have enough time. We got to the end of the show, and they even said, "Sorry, Kirk, we can't allow any questions because you talk too much."
I do. Guilty.
So I had my questions all lined up, and I figured, well, the only way that I get to ask them is to bring you on the show and ask you directly. So here we go. If you're ready for this, all right. So I have my first question, and it's a loaded one. Okay. But while I was watching the video, I actually took a screen grab during the live presentation. And I love your software. I'm very interested in bot trading. And one of the things that I saw was you're throwing out some numbers. You got an alpha, you got an expected value, a probability of profit. And my first thought was, what if I get out of the trade early? If I'm doing these trades and I'm seeing these numbers, does this always assume that I'm going to hold this trade or this position or the strategy all the way to expiration? And I'm kind of wondering what your software does to account for that, or how you address that scenario.
Yeah, so we do in all of those calculations, which I think what you're talking about is on all of our position screens, whether you have a new position or even an existing position, it'll recalculate these on the fly all the time, is we show things like expected value, which is, I think, one of our biggest things that we show is expected value in alpha. It's completely different than how a lot of people do it, not only because it's virtually impossible for people to do it in their mind, like you have to have a computer do it, like a server run these calculations. But I think it's been something that people have kind of sort of like done a little bit, back of the envelope on a napkin when they trade, they kind of calculate these or kind of know. But we take it a step further by calculating the regression of each of the different slopes of position payoff diagrams and partial profit zones and partial loss zones. So we try to throw as much information as we can into it to see, like, does this trade that you have either now or a trade that you're looking to get into, does it have positive expected value, negative expected value? And yeah, those assume that you hold till expiration. So because we don't know what's going to happen with the position, right? Like that's the easiest way to compare, thousands and millions of trades in a day is to compare them all the way to expiration. Because if you needed to hold it, you would hold it all the way to expiration, right? So if you get out of a trade early, that would dramatically shift, the distribution of everything, right? Because you close it early, you're going to take profits early, but do you really, I don't know how that would, shift with the payoff diagram. It would probably be very, very different for every position. So, but we really like alpha and using EV and using those as kind of, two of the benchmarks that you can look at. They're not the end all be all, but they're good things to reference and, risk reward and things like that. Like you should take a look at those for sure.
And I agree with that. And one of the biggest things is I've always said, you got to take what the market gives you. You got to take the information that's out there and make the decision at that second. So just like not even close to perfect example, but like, if I buy an option contract because I like the delta, because I want this type of stock representation, that's what I can do. I can look at delta. It will show me the representation that I'll get from that option contract. I don't know where it's going to end up at the very end, where that delta is going to be, where that option is going to go. But that's information that's given to me that can help me make my decision on which option contract I can buy. Now, when we're going here and you're looking at expected value, and I'm not quite sure as much about alpha. I think I'd like you to kind of define alpha a little bit more. Expected value is straightforward, totally understand it just by saying it, and I get excited about those numbers and about having that type of information. But once like you said, the marketplace is giving you some information. You have to take that, and the fact that you guys can run these iterations over and over again and give you that number so quickly can just really help with your trading decision. I don't, you find a strategy, you like it, you toss it in there, and you see, oh my gosh, does the rest of the marketplace think that this is a good trade based off of those numbers? And I love that concept about it. But that was my first question that I have, and so I would lean into a little bit about alpha.
Yeah. And so just to even like hit on EV for a second too, before we jump into alpha, but like the way that we think about it is actually maybe just slightly differently now, which is that, like the older way, like we call it the 1.0 way of trading, was you determined what position you wanted to analyze and you went and sought out that position. So I want a 30 delta, 15 delta, whatever. And so the new way we kind of think about it is, well, like what type of exposure do you want? What are the general characteristics of the position type that you would accept? And now let's go shopping for that type of trade, which is a different experience because now you're telling the market, you're saying, look, show me trades that are, 70% chance of success winners, at least 5% out of the money with a $5 spread and positive expected value between these day ranges. And you let technology do all of the analysis and ranking for you to present it to you in a list that says like, okay, these are the trades that fit your criteria ranked how you want. And then from there, you can kind of pick and choose. And so our thought process is, how can we help traders find and get into better positions? Because what tends to happen is people get into positions however they get into them, and then they try to be really, really good at adjustments management, everything like that, which there's no disputing that can help for sure. But it's like putting lipstick on a pig. Like if you get into a pig trade, like no amount of adjusting is going to save you from a bad position, right? So that's how we kind of think about it. With regard to alpha, the way that alpha kind of came up, we actually went through one iteration very quickly on alpha that was really overly complex. We were trying to like overthink it and algorithm, like a calculation. And we came up with an idea of actually just making it really simple. What we're trying to do is figure out, okay, we have all of these trades that are, showing expected values, and some expected values on a trade are $200 and some are $5, but there's no way to normalize that to a certain degree. Like if you're trading SPX versus USO or GLD, like those premiums are just not the same. So you can't look at expected value on the surface and say, I should only take the highest expected value because there's no normalization to it. So what we do with alpha is very simple. Is we take the expected value and we divide it by the max loss for the position. And so that is a way to then normalize essentially like how many units of expected value are you capturing for each unit of risk that you're taking. And so with alpha, you can then say, okay, I want to take conceivably the highest alpha trades, which is the highest expected value per unit of risk that I'm taking. Does that make sense?
Yeah, it does. And then one thing, then that generated another question in my mind. So you're saying that we're looking for expected value. We're searching the entire marketplace to look for these trades. Are you defining the strategy before you start that search?
You can define it. So like inside trade ideas, if you wanted to say only look at credit spreads or even only look at debit spreads, which is actually pretty fascinating. Like I've personally found it fascinating if you go in and you start searching specifically for debit spreads. It's amazing. Like some trades that like actually end up working out and you're like, well, that, some people would say like that would never work because like option buying doesn't work, but like just the math is the math, what the math is. And like some of these trades, look like they have good fundamentals mathematically. So you can search for any type of trade. You can say like, just show me everything that's there. Or you can say, I only want credit spreads that are bullish, positions only. So, only short put spreads. I want neutral.
So that would combine short put spreads and long call spreads.
Yeah, you can look at both short put
Because
spreads.
those are both bullish trades and they're both spreads, right?
Right,
So you
correct.
can get that granular, I guess.
Yeah, for sure. You can see, and then you can even filter from there and say, okay, I want, I mean, there's so much more filtering you can do, but yeah, you can filter by strategy type and to see what you would want to add.
All right. So I have so many other questions, but that is a derivative. That a question came
No
up
pun intended there.
out of that conversation is that so a lot of times you get a lot of people that say you have to sell options to make money. In other words, you've got to be short theta and selling things for a credit, because 80% of all option contracts expire worthless, which literally make 0 cents at all, because you have a call and you have a put. One of them's got to be in the money, right? So there's a lot of these little misnomers that are out there. And then when you throw in volatility, so here's a couple of questions. So do you always have to sell options in order to make money? Like, I think I kind of answered that question just in general. And then the second thing would be, if you're just thinking of volatility and you have a forecast of volatility, does that adjust your strategy ever? Does that ever can we account for that in the software if we expect vols to go higher? And in theory, if vols are going higher, you should be a buyer of the market as opposed to a seller. And that's where I think a lot of people come in and say there's a golden book of answers. You got to sell option contracts to be profitable. And to me, I say you got to take what the market gives. And I'd kind of like to get your thoughts on that a little bit.
Yeah, I say the same thing. I think that like AQR did a pretty good piece of research on this. It's like a third party like anecdote, right? So if people don't believe me or don't believe you or whatever, they like go look at a lot of third party research on this. And the end result is that the volatility risk premium is there for most of the deciles that you could possibly test for volatility, which means that in many, many, many cases, there's volatility premium that's built in, suggesting that selling premium is better than buying premium, broad spectrum for many deciles. But then when you get to like the further extremes where volatility becomes very, very aggressive and moves very, very fast, that's where those periods are where it actually makes a lot more sense to buy premium. So you could say that like low VIX, low volatility periods, you got your best shot. It doesn't mean that like I think a misconception, because we've seen this in the last year and a half, 2 years, like just because the VIX is low doesn't mean it's going to go right back up. Like it's not a bungee cord, like it could be low and it could stay low and it could continue to go lower, but it's giving you the best shot. Like I wouldn't be buying options at a 50 VIX, like that probably is not where you should be. Right. And likewise, you should probably maybe position size yourself down if you're selling premium with a low VIX in the 12 handle, right? And so I think that you should be adjusting it for the volatility regime that you're in. Does that mean you shift from premium selling to premium buying? Maybe it's a combination of it. Does it mean that you reduce position sizing a little bit on premium selling because you know that there's risk out there? Probably. But even still, like I think, and using like Trade ID as an option alpha, like you can go into it today, generally low VIX, low market, right? And you can find debit positions like premium buying positions that still have good math, right? So it just ends up being like, what type of positions do you want to get into? Are you willing to manage those positions? If you're going to do a long spread or a long option for something and it's going to go in the money, like, are you willing and able to manage that position or go through expiration if you wanted to? Like, there's other, I think, ancillary questions that you have to ask yourself in addition to, should I just sell or should I just buy?
Yeah. And I guess that's my point.
Yeah.
There isn't a golden book of answers, right?
Yeah.
I think you take what the marketplace gives you. And I'll give an example that I've had recently, actually, on Options Guide TV is I'm not I don't want to buy long straddles, but every once in a while, an opportunity will arise where the VIX is a little bit lower. And in particular, the Russell 2000 index, and I use the IWM ETF. If you go back and you can look for about the last year, it's kind of changed a little bit recently because of the interest rate talk and everything. It gets a little muddled, but there was a very well-defined channel in the Russell 2000 index. And Russell is a scary thing, and it can move I've always thought that the Russell volatility was lower than, just my general years of trading. So I did a lot of long straddles, buy the at-the-money call, buy the at-the-money put when we're at the lower end of the channel. And then when we get back up to the higher end of the channel, knowing that if it could break out, there's good potential. But if not, if it's going back into the channel, it was very inexpensive relative to the actual width of the channel. So I guess I bring that one up. I bring that story up in general because I really don't do a lot of long straddles. You know, the math, I mean, gosh, I would love to throw long straddles into just make that the strategy and see what the expected value is inside the software. That really intrigues me because that was a trade that has worked out many times. I think
it's a scenario.
Like 8 out of 10 of them that I did all panned out.
Yeah. Well, in your case, what you're doing is you were doing it for a scenario, for a market move, right? And you were trying to capture not only just a market move that you thought was coming, but maybe a little bit more increased volatility with that, right? And so it's a very specific, I mean, all these strategies, you know, like you write about it in your book, like every strategy has a particular market environment that it's great in, right? And it's just finding and diagnosing what environment am I in? What does the market look like? What is the best strategy right now?
Right. You just defined Options Guide TV because one of the biggest things about my show is that I just don't want to talk about covered call writing over and over again. I try to take the 40 different plays that are inside the book and try to find scenarios where they work. Mm-hmm. Right. So I just because I want the full exposure to everybody. I'm not saying that this is a better strategy than that. And gosh, that just kind of it gets me excited more and more about your software. And the fact that you can take everything in the market and even do a specific strategy like a long straddle, or you can say, I just want bullish trades or bullish strategies. I love that. I love everything about it. I got really excited when I listened to your presentation. I have to admit, because I've never really, you make me want to jump into the deep end of the pool. That's what that presentation did for me.
You should.
All right. I'm in. All right. So the other thing that I had, now I'm going to ask just about, and this continues with not a golden book of answers theme that I guess we had. I didn't know that was going to be the theme today, but I feel like that's where we're at.
It's the next book.
Yeah. One of my favorite strategies is a butterfly. And I'm going to ask you about an adjustment and how I like to use long straddles and butterflies. But do you have a favorite strategy that you like to focus on?
Yeah,
is there one out there?
I've always liked iron condors and all the derivatives of. I like liking into them. I like spreads. I like doing iron butterflies. It's one that I've always gravitated towards. It's just been the easiest one for me, and I think people generally like it too. But there's just something about just doing just some nice big fat wide iron condors and hoping that most of the premium gets left off and expired and you don't have to deal with it. So that tends to be my favorite.
So that leads right into the 0 DTE and all the different expirations that you have available. If I'm doing iron condors in general, I prefer to do them in indexes. Mm-hmm. And in the indexes, you have a whole bunch of expirations. Do you have a time frame that you like to focus on when you're looking at your iron condors?
I think it's different. So now I personally started playing a lot more with 0 DT because we build a new tool specifically to help out with it. I've never really found like a way to do it. And hopefully this tool kind of helps out. That's why we built it to some degree. But with regard to like regular iron condors, I'm still generally in like the 30-day range, right? Okay. So, and that's mainly because most of our calculations use 30-day historical volatility. So I'm trying to match up the calculation and kind of like duration match, like what data is coming in to what you should be trading, right? And I think that ends up working out. I personally like most of it to be in that wheelhouse where things can move and I have time to assess and redeploy capital. If you need to make an adjustment, you can make an adjustment. 0 DT has been really fun, but the time frame is insanely compressed, right? So it's like a whole expiration month in a few hours. And so that means like either A, you don't have time to make adjustment, or B, you just have to deal with it. And that's okay. Maybe that leads to, just more trading on the math and numbers, which is fun. But so I'm usually either 30 days or 0 now. So not much in between.
Yeah. So 30 days gives you a little bit better chance to be wrong. Right. Yep. But on 0, so on a 0 DTE, do you make an adjustment or do you just say I'm putting it on for this and if it goes against me, I'm out?
Yeah. So what I've been trying to do is make multiple trades throughout the morning. I don't know if this is going to work out. So I'm truly just spitballing all this right now and trying to figure it out. We have a big community of people who trade 0 DT. So I've been like watching what they do. I see what their bot templates are. I understand it, but my kind of thing right now is to add iron butterfly positions kind of right around where the market is trading, and then make long call, long put adjustments, from there, and add some additional wings. Like at the end of the day, like towards the later hours in the afternoon, like those wings get insanely cheap. And it's just real cheap protection in case the market has a big up move at the end of the day or down move at the end of the day. And all I'm trying to do is just capture like a fatter zone using 2 iron butterflies or 3 iron butterflies during the day. So it's effectively creating like an iron condor payoff diagram to some degree with some people call it
with a little bit of a curve in the middle, right?
Yeah, a little bit of a curve. Like I'm just betting on a little bit of movement somewhere in the middle. I don't know. It's worked out okay. So.
And I would agree. And, so we chatted a little bit before the show about zero DTs. And I'm assuming when we're talking about this, we should maybe let the listeners know that we're really looking at indexes, right? When you're talking about a iron butterfly, which is just really a standard butterfly, but you're selling call spread and selling a put spread. You're looking at indexes. Do you sometimes, because you have the benefit of the software, do you sometimes do them in some underlying stocks that pop up?
Yeah, no, you can if you want to. I only do it in SPX and XSP, just because of the cash settle nature of it. If I can't get out of it, I found that sometimes even in SPX, I know people say this all the time, but it's totally true. Like the fact that SPX is still the most liquid product in the world, say that to somebody at the end of the day on an SPX zero DTE position, some of those legs don't have much liquidity at the end of the day. And I get it. I understand no one wants to take the other side of that trade at the end of the day. So I think the cash settled nature of it is just easy. It's like out of my mind. I can let the bots kind of, run with a position if they want to run with the position that I dump into it, or I can just set exit options and be on my way. So.
Yeah, and I agree with it. And if you're not really familiar with cash settlement, it basically just either cash goes in your account or it doesn't. You don't have to worry about getting exercised on stock, and then the other leg doesn't get exercised, and all of a sudden you wake up Monday morning and you got long stock. Yep. You're like, how did that happen? And so you can save a lot of headaches by trading in the indexes if you can get the liquidity that you really want. And you're right. I have looked at, and that's my favorite trade to do in the zero DT. And I did this, and I like to do it going into the holidays. And it's once again, your feel for the marketplace. But unfortunately, over the 4th of July, we actually set records in the marketplace. I don't even know where that came from, because all of a sudden we're at record highs in the NASDAQ and the SPX while everybody was watching fireworks.
Yep.
But I love butterflies are the most interesting strategy out there on a pricing perspective. As a matter of fact, way back in the day, because I used to be at the Chicago Board Option Exchange, I was an instructor at the Options Institute, and we actually would train market makers down on the floor. We'd train floor clerks, and we would always talk about the fact that way back when, the market makers used butterflies to make sure their options were priced correctly, because you can't have a free butterfly, right? So if you use those scenarios and you look at it, you got to be careful with the way that you're quoting your option contracts, or else you'll end up having a situation where somebody can buy a butterfly for a net credit, a standard butterfly, right? So when you get down to the zero DTE, it is a short theta trade. And even though you're paying that net debit, if you're correct on your forecast, you need that at the money option contract to wither away. And from noon until 4 o'clock Eastern time in the markets, man, do those butterflies move a lot.
They do.
And you just need the market to sit, right?
Which, it's funny, they do move a lot, and yet at the same time, sometimes they don't. Sometimes it feels like they don't move until the end of the day,
And I agree with that. So the way I look at it is, if I put it on at, let's say, 10 a.m., you got it a couple hours to figure out if you're right.
Yep.
Because if it moves and it gets outside of the wings, I'm out.
Yeah.
Because you can tell that some of that time premium, and it helps if you are incorrect on your forecast on a butterfly, time premium helps you. So I got in that. I do like the zero DTEs, and I like butterflies in particular.
And one other thing that's interesting too, and so when we run it, with our tool, the zero DTE Oracle for the zero DTE positions, we run it for the time that you're actually looking at the market, right?
Yeah.
And so what I found, and this is just anecdotally, we don't have enough data to like do a comprehensive study on this yet, but I'm sure we will at some point. But what we found, and we've even chatted about this as a team internally, is that like around 12 to 1, 2, there's really not a lot that's good trade wise. It's almost like the premium has been gone. And then maybe you capture that afternoon session where you can, kind of pick up pennies in front of a steamroller. Not necessarily that you would, but you know what I mean? You're kind of capturing premium. You're taking a lot of risk, but there's a short amount of time. But it does seem like that early morning and then that later afternoon. And again, I don't have a bunch of data to back this up. It's only experience just kind of watching it. Seems like it's the more premier times.
All right. And so with that said, I think that's a great segue into an adjustment that I'd actually like to talk to you a little bit about. Now,
Sure.
I think you kind of addressed it. We don't really you within the software and within the bot trading, you're looking for good setups, but it also helps to know how to adjust something. And one of my favorite things to do, and we've already talked about both of the strategies, is the long a call spread, a call debit spread, a vertical spread. Those are some of the names for it. And when the market goes against me and I'm wrong, because I know what to do when I'm right, that's an easy scenario. But if the market would go down, and in the SPX, I've noticed that it probably go down half or maybe 1% from where I put the trade on. I'm usually going out at least a week, maybe a little more. And what I will do is actually sell the credit spread. So you're long a call spread, you're long one option, you're short one option. We're going to sell that same option and then buy another one and bring in a net credit to the account. And I always treat it this way, Kirk, is I always like to think of it as, I don't want the cheese anymore. Just let me out of the trap. If I close the long spread, I'm done. There's nothing I can do. I can sell that credit spread and bring in a credit. It won't be as much as if I actually sold the long spread, but I still got a chip in a chair. I'm still in the marketplace. And if I can get that bounce back and it lands somewhere within the butterfly strikes, I can salvage something in that scenario.
Yeah.
Is there a way that the software can help out in this scenario, or is that just you got the right setup and then this is an adjustment after the fact?
Yeah, so we don't do adjustments automated yet. That's something that we've been trying to work on for quite some time.
So in other words, if I say, okay, so this would be a great example. I pay $3 for 5 point. I'd usually do bigger, but that's fine. $3 for a 5-point wide butterfly. And if I say the credit spread is trading for, let's say, $2, right? Then you're just going to execute the trade?
Yeah, I mean, you can enter and exit positions all you want and do all that other stuff. You can actually do, there's ways that, and I posted templates about like using, for example, iron condors and adjusting the spreads inside of iron condors, right? Okay. But you got to do some position tagging. It's definitely more advanced. It's not as easy as it, potentially could be, but there's also a lot of challenges around adjusting, which is like, you have to know exactly where you're adjusting to from like a regulatory side. We can't pick your adjustment for you. You would have to like specifically tell the bot what to do and where it would be going and how much premium. And then there's also like a remaining leg thing left over for some stuff. So if you were to split the position, what happens to the remaining legs? How do you manage those? How do you tell the bot to manage those or not? So there's some considerations that we just haven't solved yet. Not that they can't be solved. We just haven't solved them yet. But right. I think when it comes to making adjustments, that's always going to be something that probably has, at least for right now, like some sort of trader intervention. To maybe you just get a notification from your bot that your bot sends you an alert, says, hey, I could close this position or you could adjust it, but let me know, or whatever. I'll do something by the end of the day. And you go.
Well, I'm adjusting if the midpoint is at a certain credit on that.
Yeah, and you can check that, and you can check that. You can do individual legs. You can do the probability of like something that I like to do. It's not an adjustment in the traditional sense, but even just managing positions closer to expiration is like, I'll check the intrinsic value, I'll check the extrinsic value, I'll check the probability of it being in the money, I'll check the individual leg strikes. Like you can check all of those things and then make that determination to say, yeah, I want to get out of this thing. Like it's probably high assignment risk, right? And then get out of it. So you can do stuff like that too. But then adding new positions, that would be something where you'd have to tag the bot and say, all right, I want to add a new position, and this is what I specifically want to do to add that position.
Well, awesome. We're coming up on time here, so I want to finish with a little bit of fun, Kirk, if we could, and then tell us a little bit more about your information and how to get a hold of you and everything. So we're streaming this live right now on x.com through my handle, and I think also through your handle on x.com. But mine is at Brian Overby, and I threw out a little kind of silly tweet yesterday while I was welding on my pontoon. And in that tweet, I told our viewers that I was going to ask you how to pronounce your last name.
Yes.
And I'm wondering, did I butcher it at the beginning of the show, or how did I do?
No, you did good. You did good. I say Duplessis, but like funny enough, and I've talked about this with many, many people, but I say Duplessis. I don't know if that's the right way for me to say, because that's how my family said it forever. But I actually get a lot of emails from people who are either in France or South Africa, because it's a very popular last name in South Africa. And they tell me, they're like, listen, you're doing it wrong. It's supposed to be this. It's supposed to be that. And I get multiple versions. People have sent me audio recordings of like how I should say my last name. So it's anybody's guess, honestly.
So that is so funny, because I just was trying to be stupid on my tweet, honestly. And it is an actual issue.
Yeah. So. Yeah. Listen, I also get Mr. Plessis. Like I get, robocalls where like, cause there's a space in our last name. And so I get all of them. Every version of it I've gotten. So no worries. I don't take any offense.
All right. Well, this is awesome. Thank you so much for coming in on the show. And let's try not to go 9 years before we have a public conversation again.
Awesome. Thank you. I appreciate it.
And let the viewers know where can they find more information about
you can just go to optionalpha.com. You can start a free trial. Everything in there you can test out. We don't like gate anything in there during your free trial. So kick the tires on everything. We built a brand new platform that we've had for many years now that we really believe in, and all of the people who work here at Option Alpha, we're all traders too. So like we built this for us, for you guys. We have a massive community of people in there trading and sharing ideas and templates. So go check it out, see if it's something that might help with your trading. And we'd love to know your feedback for sure.
All right, that's it for this edition of Options Guy TV. We'll be back Monday at 11 a.m. Eastern time. If you're inside the Tradier YouTube channel, please click subscribe and ring the bell so you get all the notifications. And hopefully you've set up a profile inside the Tradier Hub where you'll have access to all the great speakers like Kurt, myself, and a plethora of others. So see you this Monday, 11 a.m. Eastern time. Thanks for stopping.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.